Hi everyone, today we are talking about investors, my favorite topic on earth. So today you can ask every question you want about investors, is allowed. So I think the first thing to say about investors is that as a startup, you have to understand why you need investor and why you want to fundraise or why you want to be in position where you want to have a discussion with investors. And I think that what a lot of entrepreneurs have a hard time to do, it's to put themselves in the shoes of investors and try to think like investors. You know, one of the things I always see as entrepreneurs is that entrepreneurs think as entrepreneurs and they don't get why investors react the way they react, and it creates a lot of tension. But the point is that the power is in the hand of investors, not you. And if you want to reverse that power, the first thing you have to do is that you have to know. Like Sun Tzu said, if you want to win over your enemy, you have to know your enemy. I love this kind of code because it doesn't bring anything, but it makes you look smart. Like the guy read Sun Tzu, yeah, on cours.com, like everyone. So when and where money matters. So startups needs money to grow. It's very easy. Like if you want to build something big, at some point you need a lot of money. Why? Because if you are just using the money of your service or of your revenue, you will be limited in your growth rate. And if you want to accelerate that, you need to be in a position where you are able to ask money for investor and to grow. So like the place where you are able to fundraise money, obviously, is when you feel that you need it less. And I think that's the first thing you have to say about it, is that understand that investors don't invest in risky business. Of course, there is always an element of risk. Of course, some investors take more risk than others. But in the grand scheme of things, in all the opportunities they have, they will always choose the one where they have the feeling that it will be the best opportunity for their fund, for their investors, their own investors, or for themselves when they are angel investors. So the first thing you have to do is that when you talk to an investor, you have to understand that you are not the only company to talk. And you have to just understand that thousands of people will talk it to him. And so you're in this competition with every invisible people. So one of the first confusion entrepreneurs do is to say, oh, my project is so good, you should invest. Yeah, but there is a lot of good projects and I don't have enough money to put in every good project. I have to choose. So the question is why it should be you and not someone else. So getting picked by an investor over another project is always a question of relative momentum, because you have two things that get in the situation is why do you need money? Does people feel comfortable? But also when do you need money? For example, if you talk to an investor that already did a lot of investment, he will be maybe in a position where he's not able to do an investment right now because he needs to raise his next fund or things like that. So there is a lot of external pressure that goes around fundraising that are not due to your project. And also things like simple like, does he like you? There is a match or not a match? There is a feeling or not a feeling? All of that go in range. So one of the things that we always say about investors in Europe is that it's harder to fundraise, it's harder to get money, but actually it's not really true. Like it's much more complicated than that. So if you look Europe versus US on a macro perspective, there is much more money in US than in Europe. That's not a debate. Like there is 10 times, 20 times more money invested in startup in the United States than all over Europe. But in the same time, you have to understand the reality that all this money is invested in very few projects. So the competition is really, really, really hard, especially in early stage. So earlier you are in your project, like smaller your company is early in the time frame of the life of your company, more the investment market will be local. Bigger your company is, more and more success you have, and more the capital market will be global. So when you hear about companies that fundraise in United States and stay in France, you have to always remind yourself that there is two reasons for that. One of the reasons is that the founder knows someone that knows someone, or personal connection or personal thing, and that you cannot fake it. Like you cannot fake personal relation. Or it's because the company is really big. And it's so important that no one cares where the company is. So as more you have success, more the capital will be mobile, go all over the world, and will be available for you. So what we don't often tell you about Europe is that capital is less pressure, less competition, and it means that in the same time, because starting a company is becoming cheaper and cheaper year over year, because cloud computing price is dropping, because incubators are doing good work, because it's more common, because what we are doing right now, all of that makes creating a company an easier task. And because it is easier, in the same time, the fact that we need less make Europe very competitive. Because one of the things we never tell you about the comparison is that €1 is not equal to $1. And I'm not talking about currency exchange rate. I'm really talking about the fact that everything in Silicon Valley will cost 3 times the price that it will cost in Europe. So you don't have this equality of amount. Raising $1 million in Silicon Valley will be like raising 250 here in France in terms of means. Raising $10 million in Silicon Valley will be like raising maybe 4 or 3 million in France, because salaries are cheaper, rent is cheaper, everything is so cheap that you are in a position where like it's much easier to operate, and because it's much easier to operate, you are in a situation where you are able to do things with the money that people are not able to do before. But there is a reason Silicon Valley is so expensive. Because that doesn't mean that Silicon Valley is not efficient. Silicon Valley is expensive because it's the most efficient place on earth. The same reason that it's much more expensive to live in a very center neighborhood of a big city than living in a suburb like 10 miles away. By definition, there is a higher quality of life, higher standard rate in the center of the city. That doesn't mean that you cannot build a very beautiful house in the suburb. Works exactly the same. So there is good aspect of that, there is bad aspect of that. But again, if you want to play the Silicon Valley, just go to Silicon Valley. It's really it's not easy to succeed in Silicon Valley, but it's easy to play in Silicon Valley. Like it's one of the few places where, as an insider, you don't have so much upside to an outsider if what the outsider do is good. So, you know, everything we say about the American dream, blah, 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 it's true. Like, that's why it works. It doesn't mean that a lot of people get access to that. It's hard, it's very competitive, it's very complicated, but if you play the game, you have a chance. And that changes everything. 2 things about what is happening in the investment right now. The first thing is that there is a pressure to the early. More and more we are going, and less the entrepreneurs need money. So more and more the investors feel the need to put the pressure on the good entrepreneurs to put money early, to don't overvalue the company and pay a too high price. Because there is a relation between the price you sell your shares as a company and what you achieve. So if people, and because you need less and less money to achieve big things, people have the feeling that they need to give you money before you had achieved anything like that is really worth to be sure to have an access to you. And also, that's something that it's really complicated in this industry. It's a real industry where winner take alls. Meaning that if you have, let's say you are raising $5 million, and let's say you have 10 offers of investment of 5 million, only one will maybe you will take 2 at 2.5. But you will not for sure take 5 at 1 million or 10 at 500,000. Because no one will do that. It's not enough capital deployed. And so even if the VC industry is very cooperative early, deals are very, very competitive. And because deals, when they are good, are very competitive, it's a game where winners take all. And that, as an entrepreneur, if you understand it well, can give you a lot of leverage. And by the way, it's one of the most difficult things to understand, because most entrepreneurs see their fundraising as a very static process. For example, a very common conversation at the family will be something like that. So I need 500,000 euro. What do you think my valuation is? I don't know. Your valuation will be what people will pay. Okay, so what do I tell people? I tell them that your valuation is 2 million. Yeah, but if I want to raise more than 500, like what happened? Your valuation increase. But how do I change my valuation? By saying it. And so people don't get that it's like an auction where if you have a lot of traction, you can change the price. But in the same time, if you go and your price is too high too early before getting traction, maybe you will not get traction at all. Like one of the strategy I always give entrepreneurs, it's called a double divide. Divide by 2 the amount you want to raise, and divide by 50% the valuation you are looking for. And so like that, people have the feeling that it's a cheap, and so you end up having more term sheet, and when that happens, double. And so what happened is that you end up raising at more valuation, at a higher valuation that you expected, and more money that you expected. And that happened, why? Because there is a lot of traction. But that traction is because people had the feeling that the deal was cheap. And think about your own psychology, how it works. Like this kind of tricks works in lots of things in life. Because you are not ready upfront to pay for something, but as soon as you are committed to pay something, increasing is very natural. Like like it's exactly like the people that scam with money gambling. They make you win a little bit at beginning, and after they take big, it's exactly the same thing. You have to give them first a victory. You have to give them first the feeling that what you are doing is great. So another thing about fundraising that you have to always keep in mind, we call it the butterfly effect. You know, I love that thing because it's one of the misconceptions in science that people always tell. It comes from a famous quote from the chaos theory theorist that invented the notion of chaos. And he said a butterfly wing in South Pole can create a hurricane year after in the North Pole. And so people understand that there is a causality between the butterfly and the hurricane. But actually it's because there is no causality that it can happen. So I will not go into details, but if you want to really read about that, it's really fascinating. So why we call that butterfly effect? Because entrepreneurs want to control everything around their fundraising. Who will see the folder, who they will talk to, how they will get intro. When people start to optimize their fundraising, they optimize like hell. And we notice something. More you over-optimize your fundraising, and more you end up with crazy stories. Like small details that become a big things, and because you take too long, people dig a little bit too much, and it can end up like, you know, in a pain. So get something simple. More someone has the feeling to do a bad deal, and I'm talking about a feeling. Because no one can judge the reality of a good deal or a bad deal. It's much more about the psychology and the feeling of doing a good deal versus a bad deal. More you will be cautious about the deal itself. And I can tell you one of the most traumatizing story of my life about that, because I'm responsible of the bankrupt of one of our startup at the beginning of the family because of that. We had a startup that had a huge early traction and was really in position to build a world leader around what they are doing. And we went in fundraising, and fundraising went crazy. And I did something I should not have done, is that we increased valuation to a level that was unsustainable. Like, the company was 7 months years old, and we signed a term sheet at a $25 million investment at a 100 million valuation for a company that is 6 months years old. And what happened is that I remember having a breakfast with a guy in London, and it was very early days in the family. So how's the family is doing? And I was like, yeah, you know what? We signed our first term sheet at 100 million, 25 million for a 6-month-old company. And the guy looked at me and said, that deal will never happen. I was like, what? It's signed. Like, I told him, look, in 10 years, I never saw a term sheet broke. Never. And the guy looked at me and said, you know what? Sorry for the expression. French investors are weak. And so, okay, you screw them up in the room with the deal. But now they have 3 months to think. And you know what will happen? You will live the most horrible due diligence in your life. Because the guy will be so stressed to tell his boss that he signed the most expensive term sheet in the history of venture in Europe, that there is no way that he doesn't find something inside your company to broke the term sheet. And I went out from the breakfast telling myself, that guy is so stupid. 4 weeks later, term sheet was broke. And on a crazy accounting audit, like a kind of audit that any company leave, it will broke. Because the truth is that most of the company have their accounting that is, like first year, second year in startups, it's always a bit shitty. So if you apply like real rules of accounting, no one can survive. And the guys was so stressed that they was like, oh, there is any tax impact, or we are paying so much, what are the real numbers, blah, blah. And they're starting to dig so much that when you dig as much as that, you have the feeling that the company is worth nothing. Because no startup is worth anything at the beginning, whatever valuation you apply. And the company lost. I mean, like that company was able to be a top leader on the market, and now they lost. And in the same time, there was a London company that was raising at a very under market rate. And investors had the feeling that they did such a good deal that 6 months later they put a crazy amount of money. And when, like, it's funny because that company became one of our friend and investor, and I was telling him, what did you told them to raise 6 months later after your fundraising? No one raised 6 months later. So yeah, I told them they did such a good deal 6 months ago that they need to help me now. That was the argumentation. So you see, like, you have the feeling that all of that is rational, based on numbers and business plan and blah, blah, blah. But all of that is just an underlining rule around good deal, bad deal. More someone has a feeling to do a good deal, less everything behind will matter. And more he has a feeling to do a bad deal, more all of that will matter. And it's your job to play with that. Because early you are, more you want people having the feeling that they do a good deal. And more your company is strong, more your company is built, like with real value, real revenue, real traction. And so you don't fear due diligence and all of that. In that case, you can make everyone do bad deals because you know that you are very strong. So that playing, it's what will help you avoid the butterfly effect. Because butterfly effect can really crush your company. Small details that become so big because people are looking for these small details. So there is 4 questions that are so obvious that you should ask yourself all the time, but I want to tell you about it again. It's what, who, how, why. So every fundraising are an optimization around these 4 things. What is, which kind of money do I get? Is it a loan? Is it a capital? How much? Blah, blah, blah. Who is giving me this money? And by the way, every money is not equal. That's something that is hard to understand, but for example, getting money from a very famous investors always give you more than getting money from someone, I don't know, a small investment firm no one ever heard about. So who gives you the money as much value of what they are giving you? How? So that's a tricky question because it comes down to the legal terms. And there is something that is so horrible in the VC world, is that the condition negotiation always come after the money negotiation. You negotiate money and after condition. And it creates a situation where you end up getting so bad condition that it's better to don't take the money. Because condition, like some investors are crazy. Like we know that there is a correlation. Like more the conditions are simple, better the investor is. Bad investors do very complicated condition. But the how matters how much than the what. And why? And here, you know, like it's in this little why that lie down all the trouble around relationship between investors and entrepreneurs. Because investors always like are not very sincere about the why, and entrepreneurs always lie to themselves about the why. So a very common conversation between investors and entrepreneurs. If you get a 10 million offer, will you sell? And entrepreneurs, if they are trained well, they will say, no, we are here to do a big things, blah, blah, blah. But believe me, don't train yourself too much on that. Just tell the truth. It's better to don't get the money than get the money on the misconception of your ambition. Because one day you will get that offer of 10 million if it works out. And if you want to accept it and you said that you will not accept it, trouble starts. And how people feel that, you know, it's exactly like in a couple when people say things just because they want to go in bed. And that can work for very short-term relationship. It doesn't work on long-term relationship. Because you always pay the price. At the moment, you know, like they will end up discovering the truth. Same thing with investors. Where is the problem? The problem is that when an entrepreneur fundraises, he always optimizes what? Sometimes he optimizes who. Sometimes he's aware of how, but the why doesn't care. No one cares. Like, it's really fucking insane. It's the only thing that will make your relationship really good and for a long time, and people don't talk about that. For example, when we fundraise at the family, we always tell people that we will never sell the family. You don't imagine how much money we lost on the table just because of this sentence. Like, I think, like, we raised 6 million, we can have raised like 60 million. No kidding. If I just go out and say my plan is to sell the family to Google in 5 years. If I just say this magic sentence, thousands of money will come. And like, by the way, I can go out, say it, and tell myself I will never do it. But big trouble comes down when there is big money. Because when there is big money involved, people take lawyers, people take bankers, people call you, people drive you crazy because there is a lot at stake. So it's much better to have a smaller amount from people that got the deal and that understand why we are saying that and how we plan to give liquidity on a very long term. And why we say that, because, by the way, we don't care so much about the who, we care a lot about the what and the how, and we are strong enough to give our own how. Because when you are experienced enough in the venture market, when it's your second or third company, you impose the how. You say that's a condition you sign or you get out. But you cannot do that if you are not very strong in your position. So as an entrepreneur, you should try to have an equilibrium between both. And by the way, one of the very novice advice I can give you for the first fundraise, just focus on the who and don't focus on the wrong thing on the who. One of my best friend is very, very successful entrepreneur. He did a company you never heard about, but he sold it to Yahoo for 500 million. It's a very technical company. And I learned a lesson with him 10 years ago, because 10 years ago, we was both young entrepreneurs raising money for the first time. And he started to read, you have to imagine that 10 years ago when you was trying to fundraise, it was not our time. You cannot go on Google and say, I want to fundraise and get a lot of articles. It was so complicated to get someone that did it already, that to give you advice or to get knowledge and blah, blah, blah. So, no, because it's so funny. And so at some point, the guy was like, okay, look, dude, I'm so tired of this shit. So I will see every investor and I will go to drink a beer. And the guy that get drunk with me and is fine and fun, I take the money. And I don't take, whatever his conditions are. I was like, are you fucking serious? You cannot, I was more on the serious side. I was like, yeah, you have to optimize about the condition, blah, blah. So I raised at 5 times his valuation. 5 times his valuation. And on short term, it was my personal victory. Because valuation looks good, it's show how smart you are, how good deal maker you are. I end up with the, I don't know how to say that nice. I saw, before yesterday, I was with one of the board members of that company. And the guy told me, I don't know how you survive to work with the devil. And that's a board member. And to say, when I see what you did with the family, how you survived that, I'm so surprised. In your position, I would have killed myself. And I can tell you, I can one day tell my story, but I end up doing boards with this guy that was so fucking stellar. And being in a situation where the guy was just evil cop. And the other guy, he raised at 5 times less maybe, but he had so much fun. He went to the valley, introduced to his friends, and he did an incredibly good company, and he was right. And so now, when I see people struggling at understanding fundraising, because it's so complicated, there's so many things to optimize, things like that, I always give that advice. Look, just optimize on the who, because when you optimize on the who, the what, the how, and the why will be given by someone that is nice. And again, I'm not talking about famous people, by the way, because some people optimize the who around the fact that someone is so famous. But pay attention about how people build their wealth. You have 2 kinds of ways to build your wealth. You can create something great and it's working out and you're a nice guy, or it's because you're a shark. And so it's not because you are famous that the what, how, why will be in your position. You have some people that makes other grow, and you have some people that makes other just taste little. Yeah, please. Should you choose your co-founder? Should you choose your investor like you choose your co-founder? Yes and no. Yes, no, because it's not the same criteria, and you have to understand that your investor doesn't have the skin in the game like you. Some entrepreneurs sometimes say, I want my investor to have the same skin in the game than me. And I always tell them you're stupid. Because if someone is like that, he's a co-founder, he's not an investor, and so you should listen to what he say. You know why you are able to don't listen every time what your investors say? Because they don't have the same skin in the game. Look, we have 200 companies here. One company bankrupt, I'd sleep well. 10 company bankrupt, I still sleep well. 199 companies bankrupt, I still sleep well. Like, the only case where I will have trouble sleeping is that the 200 company, there is not a single one that win for 10 years. Like, you will be like, oh my God, like, I'm that bad at cherry picking. But, so, when I give advice to entrepreneurs, it's easy. You know, I can go and tell entrepreneurs, you know what? You should go for the big thing. But at the end, the one that will get all the trouble, it's the entrepreneur. So that's why when an entrepreneur don't listen to me, I'm fine. Like, I don't have to, like, I understand. I'm like, yeah, for sure, it's your life, you do whatever. But at least I told you what I think you should do. So that mismatch creates a situation where the kind of criteria you want from your investor are different from the kind of criteria you want from your co-founder. And I think it's as easy as someone being simple. Like, best investors are very simple people, really simple. You know, each time you have these people that are so sophisticated with so much things, blah, 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 crap, always. It's because they are trying to screw you at a game you cannot play. And good investor, like Warren Buffett, that by the way is, I think, one of the best investors in the world, he called that the napkin rule. He said, if I cannot put a deal condition in a napkin, I don't do the deal. And it's a true thing, it's not a story. You know, the average budget lawyer in private equity, it's 10% of your asset. You spend in average 10% of your asset in lawyers. You know how much Warren Buffett spent in his life in lawyers? 0.2. Because he doesn't need lawyers, it's in napkins. And it works out so well for him. And I understand why. Because he focused on the right thing. Does the business is good? Does the entrepreneur is good? So yes, I can put 1,000. Like, that guy bought 15% of Goldman Sachs in a napkin. Like, Goldman Sachs people was like worrying, like, my God, like, that guy is real. Because at Goldman Sachs, they do thousands of term sheets. And they spend a lot in lawyers. So, and that's why he has a small console and he do his deals. He can do deals like that for 20 billion. So if a guy like that can do it for a 20 billion deal, why someone cannot do it for 250,000 check? Doesn't make sense. And this propension of like how you optimize really show how much experience you have. Because more experience you are, and more you will start to optimize at the how. But it's a very tricky game to optimize the how when you don't get it. So better to leave, like really for first time fundraising, the best advice I can give you is just look at the who and just follow, just let you follow, because it doesn't matter a lot. So the single point of money is to go faster. And the funny thing is that I think in half of companies that fundraise, maybe 70%, I don't know, but in a very large proportion of companies that raise, money gets them slower. And it's easy to understand. So the first thing, there is a joke that every entrepreneurs know, every investors know, is that when you invest in a company, the month after the investment is always the worst month in history of the company. Always. It's so funny. Like we have this chart, you know, with the growth of all of the company, and you always have an accident. Always. And we call that the anti-Midas touch. It's that, you know, Midas put his hand on something and transform in gold. And we call that because you put money, it transform in rubbish. So it's anti-Midas gold. So actually it's normal. Why? Because fundraising forces entrepreneurs to over-deliver. What happened during fundraising is that because you want to look good, you put yourself in such of tension that everything looks good. You invest a lot, you work a lot. Every single client you can get, you will get it just to show better numbers. Your team will stay very late. And when the fundraising is done, because it looks like a milestone, pressure go down, you know, like so directly. And what happens is that you always need few weeks or few months to get back on track, because that decompression has an effect on your company. But here's the thing. Some people never get out of the decompression. Because some people with money start to do stupid things. And you don't know why. And one of the reasons is that it comes down to look serious. Because they want to look serious, so they start to do serious things. And you see things that are so funny, like people, like very scrappy people, not spending a lot, they raise and they take a fancy office. And it's not the fact that it's wrong to take a fancy office, it's just that it takes time to take a fancy office. So if you do that too early, it's unfocus you and you start small details after small details to take bad decisions. And you don't imagine how much money hurt. Like, money can accelerate you if you are very disciplined. And I think that's one of the worst tests as an entrepreneur, because no one can know how you will react after the money in any other way than giving you the money. So being capital efficient, the only way to know if you are able to be capital efficient is to give you capital. So that test is so stressful. You know, it's always, well, it's really the death of sorrow during 3 months where you are like, did I give money to a guy that will never get over it, or it will just be fine? And you have to be aware of that. Like, it's not because you have money that you will go faster. You will go faster because you are smart at using the money you raised. One of the questions we always have is, when should we raise money? When you can. It's a very simple answer. So, what we mean by when you can is that if I come back to my to my superb, I love that movie. I don't know if you saw that movie, Budapest Hotel. So if you come back to that, when you can, it means that all of these criteria will be optimized at the best. And so the real answer is that there is 2 moments to raise money: when you need it, when you can. And you have to understand that more money means less risk. It's as simple as that. You have to understand that most of the billion-dollar companies that you hear about in the press are artificially created, because at a point, an investor decides to believe in the story that the founder said. You are always late to your numbers in the venture. Because if some people invest in you based on your numbers and don't pay a premium on your numbers, meaning that they overprice you, you will never be able to build something bigger. So the only way to go from a step to another step of being bigger is not natural. Is that you need artificial injection. Think of you as a sport people that are allowed to get dope. And that's what fundraising is about. It's about really getting a dope that will make you bigger and stronger and blah, blah, blah. But that means that if you take the wrong kind of drug, it can kill you. So that's where the tricky part and equilibrium is. So, valuation. That's the most simple subject that everyone talks about in startups. There is 2 kinds of valuation: fake valuation and real valuation. Real valuation are based on only one thing: predictable revenue. Because at the end, in an infinite amount of time, you will always be valued as a multiple of your revenue. Nothing else. Like, valuation is what? Valuation is the idea that someone paid today to get at a discount on the cash flow that you will generate in future. So real valuation starts at the moment where you can be sure that your revenue are predictable, that you have kind of an inertia that make you unkillable, and that you are able to provide investors with forecasts that are so sure and people are so comfortable with that valuation will be real. Until that day, valuations are just based on the hope of that happening. And that's where the problem starts, is that, of course, you will be very optimistic Of course, investor will be very pessimistic, and the goal is to find an equilibrium in that. My advice for first round, one of the rules we have at the family that works a little bit well, is that the problem with first round is that they are so low in Europe, and we see deals in Europe like 150K for 30% of your company. That kind of deal are unacceptable for any entrepreneurs because it's way too much equity for way too little money. So 150K, by the way, looks like a lot of money, but if you think about most of the entrepreneurs, if they work for 1 year at a team of 4, just doing web agency things and saving as much as possible, they can constitute that kind of amount of money in a year. And we have a lot of companies that did it. Like one of the best companies right now in the family, they needed 100,000. They lived together in the same apartment for 6 months, reduced all their expense, and saved the money in 6 months. Was one designer, one programmer, and one biz guy. And that kind of experience creates such a good relationship between people because it shows that you can do something. And after they use that 100,000 to build a company, and they are raising the first round right now, $1 million at 3 million valuation. So, tell yourself that the first valuation, minimum valuation, should be between 1.5 and 2 million. Okay? Never less. That's the European starting point. By the way, the Valley starting point is 5 million, a little bit higher. I hope that one day we'll be here. But understand that because the first valuation you put inside your company is artificial, you have to start on a high level. So people tell us, yeah, but how can we get this valuation? And we tell people you should fundraise only if you reach that valuation. So you reverse the problem. Because you can try to fundraise 2 times, 3 times, and you do it again and again until it works. And people are ready to pay that valuation. And that can depend a lot on your conviction power, how you are able to manage it, and blah, blah, blah. Why? Because cash flow are unpredictable. And especially in startups. Like every startup always has forecasts of revenue that are crazy and blah, blah, blah. It's really uncommon, even with very good company, to achieve them. Because it's your job to be optimistic. So, of course, you want to see an exponential growth of revenue. But even with very successful company, that doesn't happen. This is why you have to be careful with that. And so don't do business plan. By all means and all gods and all prayer, don't do business plan. It doesn't work. It puts you in a very weak position of negotiation. Because every investor that asks you business plans, when they tell you that they invest only if you do a business plan, are liars. You cannot do business plan at the beginning, and when someone asks you that, you should tell him, look, I'm not here to do a business plan. That's my budget. That's how I want to spend the money you are giving me. I have no idea of how my revenue will look like or my hypotheses are. And the goal of this first fundraising is to establish a model that I can believe in. And if someone tells you in that case I don't invest, the truth is that because he doesn't want to invest. Because the business plan is just a tool to trick you around in a game where you always lose. It's nothing else.
In this case, how do you do with business angels that always ask for a business plan?
Yeah,
it means that you don't want...
You tell them to screw up. Like, again, if someone tells you, I want a business plan, and you explain him why you don't do a business plan, and he don't get it, and he say, okay, that's fine, do a business plan. You say, okay, it's not the right who. That's it. Because if someone has as a condition in first round to see a business plan, it's because he doesn't know what he's doing. That's it. It's not more complicated than that. But again, where is the problem? The problem is that every entrepreneur sees the fundraising as a mandatory step. And by the way, mandatory step that is very early. So because entrepreneurs see that as a mandatory step that should happen early, they put themselves in a situation where they cannot say no to anyone. Because they are so depressed that they want to fundraise that people ask a business plan and they work 2 weeks building a business plan instead of working 2 weeks building revenue. And again, a business plan in first round is just a set of hypotheses that doesn't work. That's it. It's not more complicated than that. And because it's not more complicated than that, you are in a position where you should be able to select your investor on that. And but I can tell you from my experience, like our company raised in first round more than 100 million in the last 24 months. 100 million in first round. I'm not talking about second round, third round. I'm talking about first round. And in 100 million, no one ever delivered a business plan and no one never asked about it. So if that is possible in France, it's just that the people that are asking you a business plan are liars. And by the way, we lost a lot of investors on the way. A lot of investors did not invest in companies at the family because there was no business plan. That's fine. Keep their money because it means that they are the wrong rule. And if they are the wrong rule, you don't want them in the cap table. Because again, this question of business plan is a rational thing. Like, I'm not saying you should not do business plan because I'm against business plan. Like, we are doing very good business plan at the family, by the way, for mature company. Like, when Save is raising the 100 million round, I can tell you that the business plan is very important because it's a proven model that you put on paper and it's not hypothesis. When Save tell you we are able to open a corner a day, it's true. They did it for 2 years. So you can put it in a business plan and you can look at what it will look like in the next 2 years. Because it's not an hypothesis, it's a fact. Like right now we are raising our Series B at the family. We are building a very complicated business model. And why? Because I have 3 years of data. So when I tell people that 20% of my company raised Series A, it's not an hypothesis, it's true. Historically, okay, maybe it will not be true in the future, but that's fine, because that's the risk. That's what people evaluate. They evaluate the difference between the past and the future, and if something happened in the past, can it happen in the future? But if something never happened, and by the way, what happened when something never happened? You are pessimistic, because you try to be realistic. And realism doesn't scientifically exist because it doesn't mean anything. Like, let's project yourself 2 years ago, you're a Save CEO, and you say, I will open a corner shop every day. And you come on stage here and you tell people, how people will react? They will say, 1 a day? It's impossible. In retail, no one did ever better than 1 a week. But when you did something impossible 2 years later, you can come on stage and say, we opened 1 corner a day and we will keep going. And you know what? You can even put in the business plan that you will open 2 or 3 a day because you did something so impossible that people can believe whatever you say. And that's where a business plan looks good because you can look at this hypothesis, how it impacts your numbers and your model. So business plans are a great tool. They have been invented by traditional economy to make people comfortable about deploying capital, but doesn't work in first round in venture. That's it. And in the same time, there is all these people that ask for business plan and never ask for a budget. I don't get it. I don't get how all these people make money. No, seriously, like you come and you ask $1 million, you do a fucking business plan where everything is a percentage of, because by the way, how people do business plan. They take their revenue, they take their hypothesis, and they say, I will spend 10% in marketing, 20% in sales, 10% in employee, and 20% in profit. Oh, magical. There is profit all the way along. We wonder why no company is doing like that. And of course, when you express your cost as a percentage of your revenue, you always end up profitable. But that's not how it works. How it works is that you spend money, and because if you spend enough money, at one point you will get revenue. But the problem here is that people ask business plan but not asking budget. When we invest money in companies here, I always ask people, what do you do with the money? And if people don't have a clear answer, if they say something like, yeah, we will invest in the team and the R&D and the marketing, like, okay, you don't have any clue of what you are doing. So learn to do things and ask me money after. But if people say, look, I need 2 back end, 1 front end, because they will develop A, B, C, and that KPI will bring me to that point where I can invest 10,000 in Facebook ads because I have a conversion rate of 20%, and that will bring me 20 million value, I'm like, okay, take my money and shut up. Because it means that people know what they are doing. And you see, budgets are very important in startups because the way you use money is the most important way. And that can be, by the way, a very good conversation of experience. Because one of the problems with novice entrepreneurs is that they don't have any clue or any idea of how they spend money. Because they will have a fake vision of their budget. They will always underestimate cost of legal, accounting, things like that. They will think that in their budget, employee can be paid that amount and it will create trouble if they are paid so low, blah, blah. So that conversation of experience that have a real value. Because when you do a budget, I can discuss with you and say, look, you are underestimating the amount of money you need. And you should maybe raise a little bit more, or you are overestimating, maybe you should raise a little bit less. That's a very interesting conversation. Not one that shows that if you grow 10% a week for 2 years, you are rich. Of course, everybody knows that. So you don't need to put a plan for that. So let's talk about the kind of capital you can raise. There is 3 kinds of capital you can raise: survival capital, growth capital, strategic capital. What is the difference between survival capital and growth capital? On survival capital, you are on a sell-side market. You have to sell yourself. Because survival capital is a capital you need to raise to survive because you need it. And because you need it, you have no other choice than being very good at convincing people. When you are raising that kind of capital, you need a very beautiful deck. You need to be in a situation where you really explain why you need money, etc. By the way, survival capital is very natural for a lot of rounds for company. Like some startups are in survival mode until IPO, and it's fine. It can work. Like there's a lot of companies that lose money and that are default dead because they have a model that is like that. But on the end, they survive. So I'm not like, don't get it as survival is good and growth is bad. Because survival capital can help for growth, by the way. We should change the name. But growth capital is different. Growth capital is a capital that you raise not because you need it to survive, but because it will just mechanically help you to grow faster. And that is the difference between the money you need and the money you can. And the goal of every startup is to go from survival mode to growth mode, where unit economics are positive, you are unit economics profitable, and if you are unit economics profitable, it means that if anything goes wrong in the fundraising market, you can become profitable in 3 or 6 months. And so if you're in this situation, you have power over your investors, and you are able to do that. Pay attention, survival capital can kill you, and I'm on the side of people believing that it's much better to kill yourself than being killed by anyone. I know it's weird, but it's something I really believe. So as an entrepreneur, you should be always in possession of your means, and you should be the one that say, okay, look, I cannot fundraise good survival capital, also I prefer to stop and do something else. And again, think about your life. It's exactly like having a bad boyfriend or girlfriend. Same thing. Sometimes it's better just to cut and be alone, because that maybe will help you to find someone better than being with someone just because you want to be with someone. So works exactly the same. Sometimes, you know, the fact, there's trouble. So I'm so sorry, dude. So sometimes it's much better to be in a position where you tell yourself, okay, if I cannot fundraise, it's because that company is not good. And if that company is not good, maybe I should do another one. And of course, you will always hear a George Clooney story. You know, I already told you about this George Clooney effect, is that people stay actors forever because George Clooney's career starts late. But again, George Clooney is George Clooney, so don't fool yourself too much. Balthazar, is one of the partners here, has a very good way of dealing with that shit with entrepreneurs. Is that when entrepreneurs are in a situation where they say, oh, I don't know if I should stop or not, he tell them, I love that thing, he tell them just kill your company for a week and see if in a week you regret it or not. Because if you're in this situation, being dead for a week doesn't hurt a lot. And if you don't have the courage to be dead for a week, you will never have the courage to be really dead, and you will keep pushing. And it really works, because people have really crazy reaction around that. Because a lot of people are like, what? A week you want to kill? Okay, so don't tell me you want to stop. You want to continue, that's fine. And some people are like, yeah, I will try the test. And of course, no one that tries the test ever survive. Because if you kill yourself for a week, you are dead forever. It's not like after a week, you're like, oh yeah, I miss the company. So, so it works well. The best survival money is love money. So I'm sorry for that, because I have the feeling sometimes to have a little bit of cultural gap around that. And I don't know how it is in different countries of Europe. But here in France, and I notice a little bit the same thing in UK, people have the feeling that love money is very dangerous. Like they are like, oh, if I take money from my friends and family and it doesn't work, they will be mad at me. And I'm like, yeah, but why are they your family of your friends? So maybe I don't have the same definition of love money. I'm lucky enough, like for me, love money comes from people that don't care. Like it's, yeah, you know, I was at an event in Israel of investors. It was so funny, because there was all these Israeli entrepreneurs going on stage and pitching great company, and the investor was supposed to do an offer, and the guy said, yeah, I can invest 150 in your company. And the guy said, like in a pure Israeli style, 150, what do you want I do with that? Like my cousin give me that for free. Like even not ask shares. And there was a cousin who was like, what? We don't get shares? No, no worry, dude, you will get share. And the guy was like, like the UK investor was like, your family give you, like they are rich? He said, no, it's all their money. And it was like, and it was a real cultural gap. So, I don't know on which side you are, if you like your friends and family or not, but ask yourself question if not. So maybe you should change friends. Love money is great, because it's money that is supposed to come with no string. Love money, like it's in the name, love money. Like it's when people come and tell me like, do you think it's good to take love money? I'm like, fuck, it's in the name, love money. Like who can be in a situation to say that it's not good? Of course it's good, and it should be good. So I don't know if when you are Lebanese it's easier than when you are French. I don't know, but maybe. but yeah, think about that. And if you have this kind of opportunity, don't be ashamed. Like also there is another thing in France. Like we had this conversation with one of our entrepreneurs. His father is very rich. And say like, yeah, I don't want to start with the money of my father. And I was like, why? Like you are already struggling to be a son, obviously. So take the money. It come like, you know, life is unequal. It's not by trying to play equal that you will succeed. That's not how it works. Like some people have family that can give a lot. Some people have family that can give nothing. That's fine. Like that's not the real problem in the world. The trouble is that people that have nothing have no opportunity. It's not that their family cannot help them. So if you're in a situation where your entourage can give you money, just take it. Like don't start to over-psychoanalyze that. It will not be a real success because I will not have suffered, blah, blah, blah. No worry, you will have pain. Like everybody have pain at the end. So it's this very Catholic view of if I don't feel the real pain, I'm not real. It's strange. It's I don't know. I don't get it, but maybe one day I will understand. So the other kind of money is the money I hope that one day you will get. It's strategic money, strategic capital. Startups are in a position that is very weird, is that they never pay dividend. So people that gave you money at some point, they want some money back. So you can organize fundraising not because you are putting more money in your company, but because you are selling shares of existing investors. And because no one wants to see that written in the press, you call it a fundraising. And for example, there is company that you hear that raise hundreds of millions. Actually, no. The founders sold their shares, and employee and angels and blah, blah, blah sold their shares for hundreds of millions. But the title looks better in the press to say that they raised hundreds of millions than saying this guy pocketed a lot of money and now they are on the island, drinking cocktails. So it's a much better title to make people think that you're in a fundraising mode. The other kind of strategic capital is that you don't need the money, but you need the money because you have a strategic reason to take it. My favorite one, and that one is like so unfair, by the way, like if you are really looking for something unfair, is that sometimes leaders on the market raise money just to not let any of the challenger raise. So for example, you are the leader and you have a challenger that is maybe a third of your size or even a tenth of your size, and you know that he's in discussion with an investor for a big round because the investor believes in that, and because the investor missed the leader, so the leader will contact the investor and say, look, instead of investing in this small, put your money inside us, we will make room for you, and so like that you don't invest. And so you suck up all the money that all your competitor can get, and you get in the big player. You don't, like that's why, for example, Stripe fundraise. Like Stripe didn't need the money from Visa, MasterCard, blah, blah. We just said, like, look, all these people can end up being in a competitor, better being with us and having some dilution than being with someone else. So strategic reason of fundraising can be a tool over your strategy. But you are far from that. Like that's a big play thing, but you know, it's like telling stories to kids. One day you will meet your prince. Same thing. Every single investor has an impact, more in France than in civilized countries. So here in Europe, we are very unequal. The only country that have corporate law that is not dump is UK. So in UK, if you have less than a 5% stake inside the company, you don't really exist. You can do whatever you want without their opinion or things. So of course, it's not a lawyer advice. Don't do that. But on the end, it will end up good. In France, it's fucking insane. Like you need signature of everyone, even if a guy put 5,000 in your company at the beginning. That's why big investor hate small investors, and you don't imagine how painful it can be. Like to chase people. No, because okay, there is a case of people are mad and crazy and they makes your life hard and blah blah blah. But that case is fine actually. No, the usual case is a guy is in holiday, no one knows where he is, you lost the phone number, and you have a fundraising in 2 days and you have to chase him down. And no one, and the guy is like, yeah, I put 5,000, what I care? And you're like, my life of company is in your hand. So that case is horrible. The case where you're in a situation where small are making your life difficult is also a pain. Because you don't have a relationship with them, because they are small investors. You start to speak about big money and every small details count for them and blah, blah, blah. Recently, I saw like, you know, when you flip a company, meaning that when you change the country where the company is incorporated, you need the unanimity of the holders. And I saw a $20,000 investment making a flip of a 100 million valuation fail. And it's a $20,000 investment. And at the end, it cost them. So it cost the founder something like 900,000 euro just to get him sign the document. 900,000 euro. And to sign the document, take him out for 20,000 check. In 1.5 years, that's a very nice investment. By the way, the company, like the founder will be in a situation where they borrow the money to do that. and because they didn't want to have the fundraising fail, they are in a situation where if the company bankrupt because it doesn't work, they will have a net loss of this 900,000 euro. It's a lot of money. Like, it's not a decision I will ever advise anyone to do. But like, that's the kind of crazy thing you have. So always think twice before letting anyone invest and how you invest. What happened if you lose the money? What happened when you lost money? Like, the market in Europe start to be fine with that. The horror story of getting chased down by the police, lawyers, blah, 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 because you lose money from investment is not so common anymore. Of course, you still have some of them because we have our tradition in Europe that are important, but not really a risk. So don't be way too worried about that. Of course, don't steal the money and don't do something that is illegal. But I mean, if you did everything right, and if you end up because it didn't work and it happens, the trouble is fine. And a lot of countries over Europe are taking out all the crazy laws around the fact that you can have your bank account marked or interdit bancaire, or I don't know what, because you bankrupt. So all of that is disappearing. I will never repeat that enough. No money is better than bad money. It's very important to understand that. It's not something that you, and again, no company is better than a bad company. Because if you think about your lifetime, the worst thing that can happen is that you lose your time. There is an incredible article you can read about that. It's on this incredible blog, waitbutwhy.com. I don't know if you know waitbutwhy.com. You can go on waitbutwhy.com and you can read the article about why you should always live your life like it was the last day in your life. And there is a very scientific rationalization of that. It's incredibly well written. Of course, it's very long. You need 2 hours to read it, like every time. But it's so smart and so well done that you should really spend these 2 hours. It will change a lot your perspective about life. So that's my beloved Jean de la Roche-Brochard quote. So Jean is the head of Kima. He was a partner at the family for 2 years. He's still a partner at the family now, even if it's part-time. And he said something that I love. He said, and the best angel investors are philanthropists at heart and investor at suit. Meaning externally they look at like investor, but in their heart they act as a philanthropist. And I think that you want from your first check a lot of positiveness. It's very important. Because first check is not so much for the money. Even if, again, it can look big, you will see that if you are successful, it's not big. Like the first 250 or 500,000, they can seem very important when it's the first fundraise, but on the long haul, it's not. What is important is a human being behind that check and how he will act. Will he call you back at 2 a.m. in the morning if you are in trouble? Will he defend you if you do something right against the will of bigger investor? Will he be your friend, your supporter? And that's why it's very important. And nothing in that world is rational. Like, you know, the finance industry likes to tell people that all of that is in models, all of that is rational, and every 10 years they come down and explain us the last crisis with the new model for the next crisis. And the truth is that it's so complicated, human behavior, that right now we don't really have model for that. So understand that all of that is a human call, it's a judgment call, and you have to, if you are bad at judgment call, you have to train yourself at judgment call, and you have some time to have a leap of faith, and if you end up with the wrong one, it will be a good lesson, and it will never be a too big price. One of the things, again, I have to warn you, is be aware of big names. It's not because it's a big names that you should not do your due diligence. And by the way, with investors, there is a very easy due diligence to do. is just talk to people that work with the investor. It's so easy. You have the portfolio of the companies because they market it. You call the guy and tell him like, that guy wants to invest me, blah, blah. By the way, if an investor cannot introduce you to entrepreneurs, if he wants to invest in you, there is something shady and weird behind that. Because he should be able to ask someone. Like sometimes investors say, oh, we cannot do that because if we do that with every investment we do, our CEOs will spend all their day long doing background check. That's a lie. Like the truth is that it takes 15 minutes on a call, and even if they do 20 investments a year and they have 20 companies in portfolio, they can do one reference check by company and by year. It will be a very, very low amount of time. If you want to be in a situation where you think a little bit about what you need to think about risk alignment. You need to think about the fact that you are, again, Jean has this expression that I love. He say, investors and entrepreneurs are on the same boat. Investors are first class and entrepreneurs are employee in the kitchen and a very low level employee. So it's not even you are traveling in second class. You are making the boat work. So again, that's fine. Like that's their job to be in first class. And by the way, it's because they are in first class that the boat exists. I'm not saying that is a problem. I'm just saying that when you are asking for equality with your entrepreneurs, with your investor, you are not understanding what you are asking for. It's not a question of equal relationship. It's a question of risk alignment. It's a question of the fact that you are aligned with what they need and what you want, and both you want something on the end that looks in the same direction. Don't believe in yourself. Seek for the extraordinary. Again, if it's just about being in startup world, go as an employee in a startup. It's much more comfortable. Like, don't think that the only way to leave the startup world is to leave it as an entrepreneur. It's so much better to be an employee than being a founder in so many aspects. And on the end, the money of employees in extraordinary venture is so big. Like, look, you know that everyone that joined Uber when Uber was valued 100 million did in average more than 50 million in stock. And we are talking about 200 people around the world joining a 100 million valuation company. It's not early stage. I'm not talking about the people that joined Uber first round, because all of them are billionaires. No, I'm talking about people that joined between employee 100 to 200, a company that was growing so fast. Like, you can have asked me, I will have told you it's obvious. Exactly the same way that everyone joining Save now, it's obvious. Or everyone that joined Captain Train 2 years ago, it was obvious. Or maybe less, etc., etc. Like, look Captain Train deal. Like, a lot of employees made more than $1 million in that deal. A lot of employees. And by the way, they get a salary too. It's not like they did $1 million because they stayed 5 years without a salary. So in terms of reward to risk, being an employee in a early, soon-to-be late-stage company is one of the best sweet spots. Because at least if the company is sold more than 100 million, it's a jackpot in terms of life and salary and blah, blah, blah. And I'm not talking about what happened next. Because, by the way, you have been a general manager of a country at Uber. You open even a small country. Everyone wants to hire you because it's a big brand name. Even if you are a very average employee, by the way. Like it's so, and if you are great, it can be extraordinary. So think very strategically about all of that. It's fine to be an entrepreneur. Anyone can be an entrepreneur, but everyone cannot. Let's dig a little bit about venture capitalists. So there is not so much to say about angels because angels doesn't exist. Angels don't exist. Angels are a mythical creature that every angel is different. Like, you cannot say, oh, angel investors do that or do that. No, it's human. They have very different situation, very different wealth, very different way of thinking. So there is not such a thing as a lesson with angels. But VC is much more easier to understand because it's an industry with rules, constraints, models, and if you understand that well, it can work. So one of the things you have to tell yourself about your investors is that whatever happened to you, they get paid. And very well. If you look at VC in Silicon Valley, in the top 10% VCs, average salary for a partner a year is between 3 to 5 million. Bonus between 10 to 20. And if they have carry interest, will be between 30 to 50. Whatever happened. So whatever happened, they are between 3 to 5 million a year. 3 to 5 million a year, you are kind of good in terms of personal life. You don't really worry about money, and it's not a very big deal in your life anymore. If you look in Europe, big fund, big names, salary will be between 300,000 to 500,000 a year. Okay, much smaller, but still, when you are doing 500,000 a year as a salary, like life is sweet. So even if they talk about the struggle of entrepreneurs, even if they tell you they share it, even if it blah, 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 there's a joke we love to tell people at the family is that we never saw an investor at ATM in the office of anyone doing work with the entrepreneurs. Like, and by the way, it's better. So because I'm not sure you want them as an employee. So understand very well that they get paid whatever happened. So don't feel too uncomfortable losing their money, because that's not the job. The job is put their money at work, put their money at risk, and if it pay big for you and for them. That's the real rationality between VC. A little bit of note about salary. Some investors tell entrepreneurs that they should not pay themselves until the company makes money. A lot of investors say that. So we have a copy and paste answer at the family, and we tell entrepreneurs to say, yes, I agree, if you do the same. Because investors take money from investors, and they take a salary to invest it to you. So if one of these people tell you that you should not take a salary, just tell them, yeah, sure, if you do the same. And if you don't do the same, I will not do the same. And the conversation will be over. And by the way, good investor never asks that. I'm not saying every investor is asking that, only bad. There is a lot of bad one. You have to fight against the bad one. And if you have no other choice, fight hard on this kind of thing. Because if at the end you raise money from a bad investor and you don't have a salary, it's a double lose. At least if you raise from a bad investor and you have a good salary, you feel your pain, but it's fine. VCs are entrepreneurs. So what I mean is that they have a business to run. And they have their own economics in that business. And you have to understand their interest. So one of that interest is that if you look at the unicorn market, for example, of these companies that are valued so much, if you look at the interest of investors, their interest is that the company are valued so much because for them, even if the company bankrupt, it will be good for the branding, and so it will help them raise more money. Because you don't raise money on things that have been realized, you raise money on hope. So again, I'm not saying it's a bad thing, but you have to be aware of that. And if you understand that their job is to raise money and get a percentage of that money as a fee to pay their salary, you understand the cycle they are in. They are in a cycle of building momentum, building hype. That comes down to the exit question. When you take money from an investor, you take the agreement that someday you will give that money back. You have to be aware of that. You cannot lie about that. Because someone that is making you a check is because he needs a check back. Okay, he's patient. He can wait 5 years, 7 years, 10 years. But you need a plan. You need to give him the confidence that the money will get back and with a premium. So if you are not aware of that, you are lying to yourself, and more than that, you are breaching the agreement you took with the investor, and that's wrong. You are not talking to an investor when you talk to a VC. You talk to an individual that have politics inside this organization. Some organizations have easy politics. Some organizations have Dallas-like politics. Some organizations are Game of Thrones. So you have to take information, you have to take knowledge, you have to take intel. You really need intel about who you are targeting, because that will change the strategy you are using. And the economics are really, 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 really complicated. So you need to understand the economics of every fund. We lived, there is a very famous fund in Paris. We sent, I think, 20 or 25 folders to him on the last 6 months, and he never did a single investment. And so I realized that his fund was done. He doesn't have any money to invest anymore. But of course, he will not go publicly and say that. I guess that because I understand, because at the beginning you are surprised, why he did no investment, and he gives you the illusion that he will do investment, because he receives you, send you to partner meetings, do a proposal of term sheet, but not a really old one with weird condition. And when you say no, they say, okay, if you don't want, we don't want. And you're like, really? Why? What happened in a year? But what happened in a year is that they are out of money to invest. It's easy. So they are raising a new fund because it's late. They cannot go on market and tell people we don't have any money anymore. Because if they tell people that, people will have a very bad view of them. And entrepreneurs, if they can lose the momentum with entrepreneurs. So you see the kind of trouble it creates. It's very important to understand that kind of mechanics. VCs are not the only way in the world. VC represent a very small percentage of company finance, successful company finance. If you look company valued more than 100 million in the world, only 3% of them, 3% took VC money. But in the same time, in Silicon Valley, for example, VC represent less than 5% of the GDP, and now the company that VC invested in represent more than 45% of the GDP. So VC, even if it's very small, has a huge impact if you are compatible with VC money. Don't think that data is absolute. Data is just like, to explain to you how it works, an investor doesn't need a reason to invest in you. He needs a reason to don't invest in you. You understand how it works? So he will decide if he wants to invest or not. In the slowest one will take an hour. Most good one will take 10 minutes. And after, if they decided yes, they will look for fake reason to don't look dumb, because they know that if they tell you yes in 10 minutes, send you a check, you will be the stressed out. Like we saw that with, like, one of the things I changed my mind about is that at the beginning we was always telling investors, you should do quick, and Index started to say to make it quick, and entrepreneurs was like, yeah, it's so weird, they did it so quick, they don't really care about us. Entrepreneurs, you are your own responsible of your situation, by the way, because you ask for something for years, and when someone do it, you're like, oh no, it doesn't feel right. So even if people decide in 10 minutes, they will make you the feeling that they ask question. But if after 10 minutes they decided it's a no, it will take them 3 weeks to explain you why it's a no. They will look for the reason. And so and sometimes if we speak about politics, you know, in some investment structure, you have the yes people and no people. So the guy that wants to say yes is the big boss, and he always takes the deal that say yes. So he decides in 10 minutes, and he have an army of people working for him just to explain to the entrepreneurs why he said no. And of course, they don't know why he said no. So they have to come up with with a good reason. We met the guy that worked for François Pinault for 20 years and say, François Pinault take an investment decision in less than 2 minutes. You look numbers, unit economics, the guy ask a question and say yes or no. And he say, my life starts when he say no, because he doesn't want that people have the feeling that he's a crazy dude. So I will spend 3 weeks building a 60-page memo to explain why we cannot invest in the company. And the truth is that I can build that exactly same memo on every company where he said yes. Because every company has trouble, every company has reason to don't invest. But his instinct is a yes, the rational is a no. So you have to understand that. And you have to not be, like, you have to understand when someone says no. Like, it's so, like, there's not such a thing horrible as an entrepreneur that try to sell out so much when there is no reason to sell more. Because it's not a prospect, it's not a client, it's an investor. If you say no, it's hard to, like, coming back 6 months later with new things, yes. That's a very good thing. Someone say no, you build up your business, you do better, 6 months later, you come back. One of the best things I ever saw in my life is a company that wanted Andreessen Horowitz as an investor. I don't know why so much. There was a fan of Mark Andreessen. And they went in a partner meeting with Mark Andreessen, and Mark Andreessen said no in 5 minutes, in a very Mark Andreessen style. This is bullshit. Okay. And they keep sending him emails every month with progress. He never replied. And one day, like a year and a half later, very short emails. This month we increased that, we did that, like investor report, but he was not an investor. And 1 year and a half later, he said, you should come back to the office. And they invested 16 millions. So it really shows how it can work. It's not because your company is not impressive now that it will not be later. But someone tell you no, and during 2 weeks you try to make him yes, that's harassment. And I can tell you investor hates that. Because their life is horrible, because it's hard to tell. You don't imagine how hard for most of them is to tell you no. It's not easy. Like, even if they try to look tough and, like, you know, we can talk about Jean again, for example, at Kima. His main job is to say no. It's horrible. It's so hard to say no. Outcome in VCs are very binary, 1 or 0. There is nothing in middle. And that's mean that you should be very careful about what you tell people when you say things like, yeah, but whatever happened, we can be a company doing $1 million a year. Yeah, okay, but that is a 0. It doesn't work. So you have to show that you are aware of your own definition of 1 and your own definition of 0. It's much more, it works much better to go and see an investor and say, look, that's my definition of success, that's my definition of failure, and I think there is a big chance of fail. Works better than saying, whatever happens, even failure looks as a win. Because no, in VC it doesn't look like that. Celebration. VC money is a nice milestone. You know, every day, every other day, every month, you have someone that come on TechCrunch and he feel himself very smart and say, oh yeah, people celebrate fundraising, but they should celebrate their company building. Yeah, of course, everybody know that. Like, of course, it doesn't mean anything. Of course, it's not because you raise money with VC that you will become a big company. Of course, it should not be something that is an end, but a start. But fuck, celebrate it. It's nice. It's a good moment. It's a good feeling because it's social proof. It means you are not crazy, or at least someone not notice that you are. So it's good. And that kind of celebration are important in life of startup. The fact is that you should not confuse celebration that is very short term in a moment and it's done, I'm successful, I don't need to work anymore. Because of course, if that celebration creates that kind of effect on you, you are dead. One of the things that changed after VC investment is reporting. Because what happened? When you are in your own business, you report to yourself. So you can have very weak reporting system and actually know very well how your company works. Because you feel it, you live it, you are in it, and you know every KPI by heart, and you know every numbers and blah, blah. So there is a difference, by the way, between tracking numbers and reporting numbers. I'm not saying that entrepreneurs before having investors are not good at tracking data. Very good entrepreneurs usually track a lot of data and very well. But between tracking data and reporting data, there is a huge gap you have to learn, is that reporting is an exercise about making that data understandable by someone that will spend 1 hour a month thinking about you. And that's a big inequality. And data reporting and performance expression and the way you structure how you express your progress can change everything in the life of your business. And we see that in inequality between entrepreneurs, between the ones that are really good at keeping their investors in line and in touch and raising every round after other rounds and every bridge, even if the company is failing, from the ones that have successful company but are so horrible at reporting that people are pissed off at them. Understanding that you enter in the world of performance means also that you need to learn how to present that performance and how you can give confidence about this performance. And another thing that happened with VC, and you should be fine with that, is that anyone can get fired at every level, including founders. Doesn't mean that you should not fight against that. It just means that you should understand that that's the kind of deal you do. Because if you take a lot of money and the company doesn't work out, you understand that the very natural consequence is that they will try to kick you out and put someone that make a better job with their money. And if you are not ready to play that game, don't take their money. Because it's an underlying condition of their money that is natural and fine. Of course, the question is, why are you fired? Are you fired because you underperform, or are you fired because you need time? And that's why I'm saying that you should be able to fight and it should not be easy to fire you. But if someone really wants you dead, there is few chance that you can survive that inside a VC-backed company, and that's fine. So be comfortable with that. VC money is the best signal ever because there is a group of stupid people that just follow that. So before and after VC, what happened? After VC, you bank like you. You are the same company, but because someone told him that the fund was great and you get the money, so the bank like you, and you have a little bit of money for a bit of time, so bank feel comfortable. So works as a big signal on your bank, and you get a lot of things that otherwise you will not get. Big signal on the press, big signal on politics, big signal on clients, big signal on everyone. For very strange reason, people will be like, oh yeah, I cannot be client of that, and they learn that someone invests a lot of money and they will become client. Every company that receives money get that signal, and you should be able to play on it, and you should use it. More and more in our industry, we see new kinds of investors that want to invest in startup, mainly hedge fund, business people, and industrial players. Novice advice is if it's your first company, avoid them. Don't go for that if it's your first company. Play it traditional, play it simple, play it nice. And remember the very good lesson you can get. More money, more problems. It's very easy. Bigger you are, bigger your problems are. Like, don't think that it gets easier. It just gets harder, stronger, because the kind of challenge you have when you have a lot of money are much more complicated, and the level of expectation is higher. So that's why it's hard. And it's a very functional, linear, it's very linear, more money, more problems. Thank you very much. So, who has any question?
I had a question about a part you talked about when you asked the startups about their budget, and then you talk about the conversion rate and all those stuff. So if you think again, we don't really know what is the conversion rate at the beginning. So it's again hard as going through the business plan.
Yeah, it's exactly because you don't know at the beginning that you have hard time to define this kind of thing. And budget is about how you will spend your money, and spending your money is not question of how much money you will make from the money you spend. So maybe I was a bit confused when I was talking, but what I meant was if an entrepreneur doesn't know where he will allocate capital and how he will allocate it and how much it will cost, and he has just a general view, it means that he's not ready yet to get money, because you need practice to, and you need a little bit of experience to know where you will spend your money and how you will spend your money. So conversion rate is typically a kind of example of thing that you will discover, and because you will discover it, you will establish a business plan.
So when is the good time to think about making a good business plan and go through the...
So it's not so much a question of time, but much more question of milestone again. And I think as soon as you start to have some historicity about how people buy what you are doing, you can be able to do a first simple version of your business plan. So you need client first, and also you need to have a data range of 6 months, 8 months of how your client react. And more you will have data, more the business plan can be complicated. So at the beginning, you will be, I think, after, if you go in a very classical way of seeing your startup, you will develop your product, do a seed round, start to scale your sales, and when you are ready for Series A, you will start to have a model. But for example, sometime that come later. So like the earlier it can come will be at Series A, but sometime it will be at Series B or even at Series C, because some companies have hard time to build this kind of thing. A good example of that is, for example, Menu Next Door. Menu Next Door is scaling a lot, growing very fast. But the problem is that the model is not liquid yet, meaning that the model of Menu Next Door right now is fake, because they push liquidity to the chef, because they know which chef they will have. So they work very hard to bring the chef, to bring people to buy the food of the chef, but it's not yet something that works by itself. You know, it's a kind of model that you need to push for a long time by hand before doing. So for a very simple question like, I open Menu Next Door app right now and I will not have food in the perimeter, so I have to move myself. Why I will move myself? Because Menu Next Door will give me an incitation like a promo code, or because they will market it a lot, or because it's cool, or because it's an event, or because there is free alcohol, or whatever you can bring. But all of that cannot be put in a business plan, because if you put all of that in a business plan, the only thing that it will show you is that the company is bankrupt. Because to make only few €100 of revenue, you need a whole infrastructure of people working very hard as a chef agent to put you in the position where you buy Menu Next Door. So the historicity in that case will not help you build a business plan. But why they are able to do a Series A? First, because they are scaling very fast, they are growing very fast. And even if it's fake and a lot of effort, the product market fit is perfect. Because everybody that live an experience right now tell you that the experience is perfect. But again, the problem is that if you want to live that on a city, you need not 300 chefs like in Brussels, but in the week you need maybe 3,000 or 5,000 chefs. So it's still bit ahead. Exactly same thing with Airbnb. When Airbnb launch a city, what they do is that they rent the apartment themselves with fake people for the first year. Because that's the only way to start the market, because people put supply if there is demand, and there is demand only if there is supply. So you cannot do anything, so they fake supply. So how they fake supply? They fake demand. So they send people that they pay to rent apartment, and they pay the apartment, and they don't tell anyone until they reach a liquidity moment. And that liquidity moment, the model works. So you see, it can be very tricky. And if you do the business plan of Airbnb using that method, it will tell you that the company is bankrupt because it doesn't work. If you pay people to go to sleep, the model doesn't exist. So you need to wait until reaching liquidity so you can get data, so you can get business plan, and it works. Yeah.
In the meantime, can you play with the data you got from the stakeholder or the clients, or?
Yeah, but not like you have a lot of data, but not financially. So you can look at product market fit, you can look at unit economics, you can look if your unit economics are profitable or not. You can look your conversion rate, your funnel, blah, blah, blah. But going from that to a business plan, it's a hard step.
Oh, no, I'm fine with that. I'm just saying, can you use the data you got on your clients, maybe to sell this data to corporate companies in order to get some money, and or is it tricky?
Never works,
right.
Because you need such an amount of data to be on market that it never works early. Okay. Usually people that sell data are really selling big data. And by the way, it's funny how much like data are very fast undervalued. Business model based on data, like very tricky, because data value is always decreasing because there is more and more open data. People get hacked. Like a good example of that, if you look Yellow Page. Yellow Page sell their address book for companies for something like 5 years ago. If you want to buy in France, every shop, everything that was in Yellow Page, and buy the database of Yellow Page, it will cost you something like 5 million a year. Okay? Last year it was 1 million a year. And they get hacked by a Russian guy that put the data of Yellow Page for $2,000 online. And so Yellow Page was in this situation where they tried to sell their data for $1 million or 100,000 or 10,000. And people are still like, yeah, even 10,000 is 5 times the price of the hacker. And how do you know that the data have been hacked? And even worse, now that scrapping capabilities are so easy to build, that companies build Yellow Page data in the system directly. And Yellow Page sue Star of Service around that. And one of the arguments we developed, and we won the case, we settled because they was so worried that we win that they settled for a very low price. They settled for 7,000 a year, I think. And one of the arguments in front of the judge was Yellow Page say that it's a huge economic disadvantage for them, but the hacker that stole them value it at 2,000. So if the hacker value it at 2,000, maybe the real value is 5,000, 6,000, but not 1 million, like they was asking. So you see, that's the problem with data, is that as soon as the data is collected, it's so hard to protect it that it doesn't have a long-term value. There is some industries that have value of the data, but in that case, you have regulation. For example, one of the things that few people knows is that Facebook did a big mistake by selling user data at the beginning. They worked with a company called Rapleaf. Rapleaf is a company in the US. You give an email of any US citizen, and they give you 700 data points about the person, where she lives, how much she makes, which insurance she took, and blah, blah. So their business is to buy every database, put them together, and sell that data. So you can personalize experience or do. And who was the first client of that? Insurance company. Because they use that data to determine risk. And you don't imagine like in the insurance industry, the level of discrimination can go very high. If you look at car insurance, like car insurance can double the price because you have a red car. because they know that everyone with a red car is a very bad driver. That's very empiric data point, but it works. And a lot of things. If you look insurance price by neighborhood, like it's horrible. Like more you live in a shitty neighborhood, more your price of insurance will be high and things like that. So the problem is that because of this kind of optimization from this kind of company, a lot of regulation appeared to impeach that company, to use that against the people. But because this regulation appears, the data wasn't valued nothing. So even the people that collected data for industry that was heavily data-driven end up not making a lot of money. So data business really uncommonly work. It's not very often that you have a data that have any value.
You spoke about valuation this morning, and you give an example of really high valuation. I'm wondering, is it not dangerous to have a too high valuation depending on the business for the long term?
So, too high valuation are very dangerous because the level of expectation are high. So it's as simple as that. More your valuation is high, more because the next round should always be higher. The probability that you get that result again is even harder. So that's the problem with high valuations. The high valuation puts you in expectation trap. In the same time, too low valuation puts you in the opposite trap, is that if your valuation is too low, the level of risk that you are willing to take will never be enough high, because any improvement will be huge compared to your starting point. And so your investor will have an interest to slow you down because they don't need that it goes too high. Because the problem is that the very amateurship vision of the world is that a company that is successful by itself, not because of the decision people take. But every decision people take inside companies have a danger in them. It can do something that will harm the company. It can do something where you will lose money and blah, blah. So the idea that we are aligned because I'm an investor and I just want that it goes as high as possible, it doesn't mean anything as high as possible. Because it will go as high as you're willing to take it, and it can stop you on the way, and you can slow down, and it creates a lot of risk. So valuation are nice because it's a very easy way to show off others. In the entrepreneurship world, like let's say you are at a dinner with 5 entrepreneurs, and people tell you like how your fundraising went, and you say, "Oh, my fundraising went so well because I refused a double dip in liquidation of preference." Like, why? Who can be excited by that? And if you say my fundraising went well because I fundraised at 20 million valuation and we was hoping to 10, you look good. So that's a very basic reason for why entrepreneurs are so obsessed about valuation. And that, by the way, you don't imagine how entrepreneurs are stupid about that. Look the unicorn club. So before, being a unicorn was not a thing. And one day there is this journalist that wrote an article about the mythical club of companies that are valued more than 1 billion. At that time, it was only 38 companies. 38 companies in the world valued more than 1 billion with VC funding. And he said that's what every investor is looking for. And because she put a name on a phenomena, a lot of entrepreneurs started to look for the press and saying, I'm a member of the Unicorn Club, and it ended up by being a joke. Now you have 200 licorn or 300 licorn, something like that, in 2 years. So like it took 20 years to get to 38, and in 2 years, a lot of unicorn appear. Why? Because before, people were never at fundraise to become a unicorn, and now it became a joke.
When you fundraise as an entrepreneur, how do you save money for yourself in order to continue taking more risk? And
that's a very good question. So, protecting yourself as an entrepreneur is as important as fundraising for your company. So, a very technical thing, you have to understand the difference between primary and secondary. So, when you fundraise money and that money goes inside the company, it's called primary. because money goes inside the company, is used by the company, it's not going in your pocket, it's not selling any share, it's creating new shares. The company creates new shares that external people buy. This is why there is dilution, because you create new shares, so it gets diluted. There is another thing called secondary. Secondary means that the money don't go inside the company, it goes in the pocket of the one that sells the shares. And there is a very bad European tradition, is that no one is allowed to do secondary until liquidity event. Liquidity event meaning IPO or 100% sale of the company. And that created a lot of trouble because you have people that build value that are paper rich, but because they have no money in the pocket, they are always worried at the end. And so it creates a kind of misalignment between the investors that are paper rich, and the entrepreneur that is paper rich, but not really rich. So I think the family really disagree on that with a lot of people, and even good people. So that is a huge debate. It's not like the thing where we disagree only with tier 2 or tier 3. Even tier 1 VC in Europe have trouble with that. So our opinion at the family is that starting on Series A, Series B, but Series A is fine. Starting as soon as possible, the entrepreneur should have a strategy of building personal wealth to secure himself and secure his family. And that goes through secondary. So the very basic way to do secondary is that when you fundraise at a valuation of 100, for example, you will sell with a discount shares that you own with a 20 or 30% discount. Never accept 50% discount because that's way too much. But up to 30% discount is fine. So why there is a discount? There is a discount because money that go inside the company doesn't have the same value than money going in your pocket. Because money going in your company produce value, or at least it's supposed to produce value. But money going in your pocket doesn't produce value for the company. This is why there is a discount. So the discounts are fine. Like some entrepreneurs have trouble to understand that. They don't see why there is a discount, but there is a factual reality about the discount. And of course, if you sell 100% of your shares, that will send a bad signal. But the idea, what we tell entrepreneurs is that they should sell between like 1 to 5% of their allocation, because that will help them to secure some money, and especially when the valuations start to be a little bit high. Because even that dilution is not so much compared to the benefit of having 2 years, 3 years, 4 years, 5 years of salary in advance if things go bad. And that comes down, to the question of insurance as an entrepreneur. You need to build policy to set up your own insurance, because you don't have, like social security like others as an entrepreneur. You don't have the same social benefit. So you have to build a very concrete strategy about protecting yourself, because if you don't do that, you will take wrong decision inside your business. So I'm a very big promoter of protecting our entrepreneurs and helping them build this kind of personal wealth strategy.
I just have a completely different question. When we have not registered a company yet, and we are at this kind of the early ages that we want to raise some money from even some private investors, like love money, or I don't know, that they, not love money, but you need to give them some percentage of the company. So what should we do? Like, should we push ourselves to register earlier? Because I remember in one of the sessions you said that we shouldn't go too early, and we should maybe start with some projects at the beginning. And
so you cannot raise money if your company is not registered. It's way too risky from a legal perspective, because if you raise money before registering your company, you take an unlimited risk on the money you take. So if I give you personally money to you as a person, like the amount of money you owe me is 100%. If I put money inside your company, your responsibility to me is limited to what you invested in the company. I cannot come and tell you, you lose my 100,000, I want 100,000 back. Because there is a company in between us that limit your responsibility. And that's why in UK companies are called limited. That's why in US they are called limited liabilities company, or in France called SAS. No, doesn't work. But that's why they are limited by responsibility. So it's very important to understand that when I said don't incorporate too early, I mean don't incorporate until you get revenue, investor, and things like that. Because you cannot act as a company without incorporating. It's just that what I see is that I see people that on day one incorporate, spend a lot of money, and 2 weeks later don't feel entrepreneurs. By the way, we have a new worldwide record at the family. I called the Guinness Book, but they told me they are not interested by that. We have a company that bankrupt in 4 minutes. Yeah, they stay incorporated for 4 minutes. So they receive incorporation at 12. At 12:04, they decided to stop the company. True story. Like, I was like, man, that's a marketing. And between both, they had a meeting with me. A 4-minute meeting. Like, world record to make people stop their project. So, and I told them, like, and by the way, I told them that they should not incorporate because I had the feeling it will end up like that. They met for the second time at that meeting if it was already incorporated. That's stupid. So it cost them 2,000 euros. That's fine. Yeah, that's so stupid. I know. It's like, you know, smartness is not linked to entrepreneurship. So yes, some consequence. Please.
If you need money at early stage, why don't you take a public grant, for example?
Good question. Public money has a very simple problem, is a way you can collect that money. So if you want to collect public money, you need to do a folder, go in front of people, get judged by these people, and you cannot imagine that that can be free. Having the wrong judge creates the wrong player. And you don't imagine how much. Because when you start to get in that thing of public money, grant, blah, 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 you end up doing that. By the way, we have a lot of companies that at the family took public money. But our opinion at the family about that is first, don't talk about it with us because we don't care. If you want to take, it's your responsibility and good luck. And third, every company that took that early is dead. And we have this data point. I sent to Nicolas Dufour, you know, a spreadsheet with 300 lines, 300 company. And every single company that took public money is dead. I'm not saying it's a scientific result. I'm just saying why. And so I have the feeling of why. Because it puts you in the wrong mindset. It puts you in a mindset where what is important is to look as a good student. You know, taking public money, you need to look good. You don't need to be a good entrepreneur. You need to look good. And that totally transforms the way you act. And it takes so long. Like at the fastest way you can get public money is a month. And if you see what you can do as an entrepreneur in a month, if you are really in the mindset of executing, it's amazing. A month, it's what it took us to take our first 12 startups at the family. A month is what took Algolia to get their first client. A month is what took Menu Next Door to do the first 100 menu. So a month is not free. But the problem is that when you take a month to do public money and then wait 2 months to receive the money, you change your natural timeline. Because you are in a 3-month timeline and you find it's cool and you receive free drugs, basically, because you receive 30,000 or 40,000. And so if you bring, sorry? Yeah, but you never receive it in one time. So sometimes it can go up to 200,000, but you never receive that kind of amount without putting that amount in capital, because it's a rule to 1-to-1. Yeah, I can tell you, no, really, like, and when you receive grant of 200,000, you never receive it in once. There is not such a thing in this country as a grant of 2,000, of 200,000, that you don't receive in multiple layers with multiple validation and a business plan and blah, blah. For example, if you want to take more than 100,000 from any public grant, you need to have a certified accounting, because it's a law, and you need to take a CFO to do a business plan that is certified by someone external. So that's a good example. So you think that 200,000 is free because it's not dilutive, and your first 3 months of conversation is with a CFO at building a plan that look like a rocket ship, and that guy will have an influence on you. Like, I believe a lot on early influence. I don't know if it's a fact, I don't know if it's true, but I have the feeling that the first person you talk about with your project and how you structure it, your entourage, have a very long-term impact about the kind of entrepreneur you become. Because it totally changed. And for example, one of the advice I always give is use the public money when you are big, strong, and you can leverage against the state. For example, Save didn't took public money until raising 10 million. And now, when we call Nicolas Dufour, the guy is begging them to take public money because he doesn't want to tell anyone that Save have been built without BPI. So now he can take, and when he take public money, he take 5, 10, even 20 million maybe. So it's totally crazy. That's thanks to your tax, by the way. I hope you feel happy with that. By the way, the money is for free, without interest rate, give back only if it works. Great use of your tax. And that's the other part of the public grant I hate, but that's a personal one, is that I feel so bad that we use average people tax to go in startups. Like, but again, that's a very personal thing. Because most of startups are crap, and that's why it's an extraordinary industry. It's because it's crap. But the problem is that you cannot take mom and pop, money to go in crap. You can take my money for crap. Like, I'm fine, I'm aware of what I'm doing. Each time I invest in a startup, I feel that I will never see the money back. And I feel it well. At the BPI, they are sure that we will do money. And you will see what will happen. In 2 years, a commission parlementaire will do evaluation, and they will say, I don't get why there is so much loss. We have to make the process harder, and the process will be harder. And I will finish on that. If you want to do a public grant that works, like I offered that so many times, but they don't want to do it, is that you will do a form online, kind of questionnaire. You fill the form, works like an insurance scoring, and they give you an amount on your bank account in less than a minute. And you don't need to explain your project. And at least we can have a democratic discussion about the criteria. For example, question can be like, where did you go to school? So if you say, I never went to school, you can have minus 10,000. If you went to Polytechnique, you can have plus 20,000. But maybe we want to live in a society that wherever the school you went is the same amount. And so criteria by criteria, you can have a very democratic conversation about the kind of country we want to be. But at least people do whatever they want with the money. And I'm sure that this kind of random money will work much better than having a guy that selects only the people that look good. Because the one that select people, so for example, when I say that, people tell me, oh, it's horrible, because if you do that, people coming from Grande École will be favorized. And say, yeah, but at least in my system it's transparent. Because what happened in BPI is that, of course, we will never tell you that they give money only for people from Grande École, but when a polytechnician arrives at BPI, people are so impressed. And when it's not, people are not impressed, so it's an even worse kind of selection. So, and so the other criticism will be like, yeah, but people will do stupid things with the money. But there is a very easy way to do that, is to say, if you take that automatic money online, you need to have an auditor inside your company. And in France, if you use the money for personal reason, you end up in jail. Because the audit, it will be obvious. On 100,000, you cannot hide. Like when you do 100 million, you can hide $1 million in personal expense. But when you have 100,000 to spend, you cannot really hide 2,000 or 3,000 in personal expense. So it will be so easy to implement at scale. Think about it if you are motivated.
If I understood right, the BP loan is good to leverage a bigger investment from private investor?
Yeah, for sure. Like whatever, every money for free is great to leverage. But it's leverage, it's not something you do at the beginning and that take time. And by the way, when you do a big investment, The leverage can be done by your lawyer or your CFO or people. You can have people that manage that kind of crap for you. When you're at the beginning, you manage it yourself, so it's bad.
Okay, thank you.
About the accelerators.
Yeah, sorry.
What about the accelerators?
So what about what?
So, no, what the investment that they put, the percentage that they take, and
That's a complicated question. So to make it simple, there is only one accelerator in the world, Y Combinator. Dot. No, Techstar is no. So you have YC. Y Combinator, it take 7% for 120,000. So they put cash on the table. They take 7%, and they offer the really best infrastructure in the world to launch a startup if you want to play the Valley game. So if you want to go in Silicon Valley and you can be taken at YC, don't think twice, go for it, it's thing. And everybody else sucks on that market.
in Europe.
In Europe, everybody too. For a very simple reason, is that the idea of, so what is an accelerator? An accelerator is someone that promises you that in 3 months, it will bring so much value that the equity it takes will be fine on that value. And I have the feeling like, for example, if you look at our value proposition as a family, is to say we take 5% of your company in exchange of a lifetime support and an infrastructure and 500,000 value of unfair and an education program and an advisory, and we feel bad about the 5%. So someone that come and say, I take between 5 to 15% and I take care of you 3 months, I don't see how, like, if we do that as a family, I think 90% of the entrepreneur will hate us. Because on the first 3 months, it's so uncommon to provide value. Because it's hard in Europe. Like in the Valley, it's so cookie making, you know? You come, you have your value proposition, you met 20 clients in a week, you go, you try, you fail, you come back, someone tell you, oh, you should meet my friend that did before, he give you an advice, blah, blah. And so YC is built on an infrastructure that works. You do the same thing in France, what happened? You come, and you struggle 4 weeks to incorporate, and 2 weeks to understand what you do, and 7 weeks to get a meeting with a client, and then you come back, and people tell you, yeah, you go on stage and talk to investor. So you go on stage and you're like, yeah, my startup is doing that, and we have a huge traction, look at it. We went from 1 to 0 client, but we have a LOI of 2 clients, and you're like, my God, it's awful. And by the way, in the room, investors, they don't have money. So what do you want to do? Like, and that's why the accelerator, that's true. That's so bad. It's totally fake. Like, yeah, but you know, you have a huge problem. You believe the story that people tell you. Okay, let's take Techstar figures. Next time you look at figure, look at how they are built. Techstar figures don't tell you about how much they fundraise at demo days. They tell you how much their company fundraise. How, in average, how long it takes at a Techstar company to fundraise after demo day? Between 6 to 9 months. What is the value of Techstar during these 6 to 9 months? 0, because they are already with the next season. So don't tell me the figures are good, because in that case, the figures are so bad. Because if you look at how much people fundraise at demo days, 0. I don't know a single Techstar company that fundraise at demo day. Like even Techstar New York, that is one of the best Techstar over the world, they struggle. It takes them 4 weeks after demo day of a specialized team to help people fundraise. And what is the Techstar model? Techstar model is to take you in front of 60 mentors in 2 weeks and change your mind 60 times with people that have 5 minutes mindset for you and 5 minutes availability of mind. So, like, don't tell me that these kind of things work. These kind of things work because entrepreneurs need brand. The truth, why do you go to Techstar? You go to Techstar because you want to put the brand Techstar and the stamp Techstar on yourself, because there is people, like you, for the instance, that say, oh yeah, you are from Techstar, so you are supposed to be good. And that creates a cycle, and that have a lot of value. And by the way, Techstar is not one of the worst because they put money, by the way. So, like, you can see it as, okay, I get a stamp, I get 80,000, I give 7% of my company, it's fine. Because on the angel market, I will not get better. But the value of accelerator, 0. Like, if you are not strong, if you don't know what you do, you end up being out of Techstar totally wash, totally like brainwash. because you don't know what you do anymore. So if you go in this kind of accelerator without a product, without knowing what you want to do, and without being strong about that, you don't get any value. So accelerator works if you take value from them, and it's hard to take value from them. And that's why we don't like to call ourselves an accelerator as a family, because we are not. Because the idea of accelerating is that YC built something unique. YC built a real acceleration. Like, look their company Boom. Like, it's fucking insane. I'm so jealous. Boom is the first supersonic jet that connects London to San Francisco in less than 4 hours. Okay, so you want to build a company like that. How do you do? I don't even know how you do. Like, yeah. So yeah, you go on BPI, you get 200,000 because you are friend with her, so you get the max amount. And with Crédit Impôt Recherche, you do some research. No, like, so they went, so that's true story because I talked with them on first week of YC. Like, they went to YC, they had a concrete plan, very high skill, very good team, totally lost about the way to do it. And YC told them, look, if you want to raise 100 million, you need to sign a contract with an aircraft. And you need to sell aircraft before anything exists. In 3 months' time at YC, they signed $5 billion revenue in letter of intent. 5 billion in 3 months. Like, they are just in another league. That's fine. Like, they reach something that is esoterical. No one can do that. Like, and they are betting on company no one can bet on. Because they build something that is so specific to the valley. They build a network, they build power, they build things. And by the way, it took them 12 years to do that. So it's not a joke. And so when people come and compare that to Techstar or Seedcamp or Numa, and they say, yeah, that's the same thing, it's just different people. You're like you really have a very low value of yourself and what it means. That doesn't mean you cannot go in this place, but you just have to be aware that there is only one accelerator in the world. And it's not the family. No, because the truth, you know what? If you think about us, if what we are doing succeed in Europe, we will be screwed by an accelerator created on top of the family. Like because if you look at what we are, we look like much more Andreessen Horowitz, poor version. That YC, and YC built something on top of that. And maybe to avoid that someone do it, maybe we will do it ourselves. But to achieve that, you need to be a huge infrastructure. So maybe I would feel too old and happy on an island and not wanted to do that. But that's what YC did. YC built something on the top of an infrastructure that was already working, with a ton of angel money that was working, with a ton of people that became rich from the previous generation. That's why when people come in countries that are so late and jet lag, and they come and they say, yeah, I will do an accelerator because I will take people for 3 months in a room and they will go at the demo day and pitch, you're like, okay, you didn't get why it works. And you didn't get what they did, what the magic they did. Like, the magic of YC is not that it's 3 months. Or the magic is not that they mentor people or put people on stage at demo days.
Que la famille.